Welcome to Breaking News to Trading Moves.
Glad to be here.
So, we are looking at a very specific headline dominating the financial space right now. It reads, AI trade faces a reality check. Nvidia, chip stocks, and the companies caught in the middle.
Right.
We have all watched these artificial intelligence stocks absolutely mint millionaires over the last year. But, what happens when the companies buying all those processors suddenly realize they actually have to make a profit off them?
Yeah, that question captures the exact market reality we are facing today. We are watching the technology sector experience a period of, really strict volatility.
Yeah, for sure.
For the past 12 months, investors focused entirely on the artificial intelligence boom. They were funding infrastructure at just an unprecedented pace.
Right, just throwing money at it.
Exactly. And now they are becoming much more selective. The market is actively questioning whether this level of infrastructure spending can continue.
So it is a reality check.
It really is. We are transitioning away from pure hype and moving toward a strict demand for measurable financial returns on all these capital investments.
Got it. So our goal for you today is straightforward. We are walking through the biggest winners and losers from these recent market developments. We're looking specifically at where the capital is moving.
Right.
But before looking at the hardware companies making the headlines, we first need to look at where artificial intelligence is actually being deployed and stored.
Which leads us directly to cloud and software providers.
Exactly. So let's start with the cloud infrastructure winners, specifically Microsoft, which trades under the ticker MSFT, and Amazon, trading under AMZN.
Yeah, these two companies remain among the biggest potential beneficiaries of this entire technological expansion.
Why is that? What gives them the edge right now?
It is entirely based on the physical requirements of the technology. Traditional software development is relatively lightweight. You write code, you run it on a standard server, and it works sequentially. But artificial intelligence is an entirely different beast.
Oh, yeah.
Training these models requires thousands of specialized graphics processing units, or GPUs, firing simultaneously in parallel.
Which is incredibly
It's
expensive.
unbelievably expensive. That requires billions of dollars in upfront capital. Plus, you need specialized cooling systems to keep the hardware from literally melting.
Oh.
And, of course, a massive power draw. Very few companies on Earth can actually afford to build that kind of physical infrastructure.
So the barrier to entry is just sky high.
Exactly. Because of that barrier to entry, hyperscalers like Microsoft and Amazon become absolutely vital. They build the data centers, and then they basically just rent out the computing power.
I see.
Microsoft, for instance, is currently benefiting from integrating these tools across its Azure cloud services, as well as its broader enterprise software ecosystem.
Okay, I understand Microsoft perfectly well. They have essentially shoved these new artificial intelligence tools into Microsoft Word, Windows, and every enterprise application they own.
Right, they are everywhere.
But how is Amazon winning here if they do not have a flagship consumer chatbot that everyone is talking about?
Well, Amazon's AWS business is essentially the foundational landlord of the modern internet.
The landlord. I like that.
Yeah. Think about it. If a startup or even a Fortune 500 company wants to build and deploy a custom application, they are not going to build their own billion-dollar server farm to do it.
No, of course not.
They rent the space, the processing power, and the storage from AWS. So the catalysts to watch here are the growth in enterprise adoption and the ongoing expansion of data center capacity.
Right, so they win either way.
Precisely. As demand for computing resources climbs, the providers of that raw infrastructure see direct continuous benefits. It really does not matter which specific software application ultimately wins the consumer market.
Which brings us perfectly to the software side of the equation. We are looking at Salesforce, ticker CRM, and Oracle, ticker ORCL.
Yes.
The focus here is moving toward companies that are successfully turning this underlying processing power into actual business applications.
Exactly. It is about utility now.
Right. So Salesforce is building these features directly into customer relationship management platforms. Meanwhile, Oracle is benefiting from demand for enterprise cloud services and business solutions powered by these new databases.
Yeah.
I kind of think about building this out right now as being a lot like building a high-speed rail network.
Oh, that is a good way to look at it.
Yeah, laying the tracks requires massive upfront capital. But eventually, you have to start selling tickets to passengers to make a profit.
Right.
Microsoft, Amazon, Salesforce, and Oracle are the ones currently selling the tickets. But let me ask you this. Why are investors suddenly demanding subscription revenue growth over raw infrastructure promises?
Well, your high-speed rail analogy explains the exact financial dynamic we're seeing in the corporate world right now.
Okay.
Laying the tracks, the infrastructure build-out is a one-time capital expenditure for the buyer. It is extremely expensive and drives massive initial revenues for the hardware companies.
But that doesn't last forever.
Right. Investors know that hardware cycles eventually peak. Once a company has built its massive data center, it does not need to build another one the very next day.
Right. They're done building for a while.
Exactly. And Wall Street values predictability above almost everything else. They want to see recurring and dependable cash flow.
Which is where subscriptions come in.
That is exactly where subscription revenue comes into play.
Hmm.
When Salesforce or Oracle sells a software solution on a monthly or annual subscription basis, that revenue is locked in. It is highly predictable.
Think about the software your own company uses. If your boss is going to authorize tripling the IT budget for new automated features, they are going to demand proof that it is actually saving time or cutting costs, right?
That is the exact proof of concept investors are looking for. They are demanding proof that everyday businesses are willing to pay ongoing subscription fees for these tools.
Because that proves it works.
Right. It proves the technology is actually delivering real productivity improvements. Because if companies will not pay a monthly subscription for the software, then all the billions of dollars spent on the physical infrastructure were basically wasted.
Wow, so the software layer validates the entire hardware layer.
That is exactly it.
Okay, so building directly on that laying the tracks analogy,
Right.
we need to look at the companies manufacturing the hardware itself.
Right.
This is where we see a bizarre paradox of soaring demand clashing with extreme valuation pressures. Let's look at the alternative semiconductor suppliers currently categorized as winners.
Yes.
We are talking about Broadcom, ticker AVGO, and Advanced Micro Devices, ticker AMD.
The momentum for these alternative suppliers is driven entirely by customer behavior and supply chain security. Right now, there is a single dominant player in the hardware space producing the most sought-after processing chips.
Right.
Large technology companies absolutely despise relying on a single supplier for their most critical components.
Because they get squeezed.
Exactly. When you rely on one vendor, you lose all your pricing leverage. If that vendor raises prices by 20%, you simply have to pay it.
Ouch. Yeah, that is not good for business.
No, it is not. Therefore, these companies are actively trying to diversify their semiconductor suppliers. This business necessity basically opens up market share for companies that can provide viable alternative hardware.
Like specialized networking solutions and data center technology.
Precisely.
Now, I understand the processor side of things, but Broadcom is highly focused on networking. Why is networking suddenly such a critical piece of this puzzle?
It comes back to the way these artificial intelligence models are trained. We mentioned earlier that they require thousands of processors working simultaneously.
Right, firing in parallel.
Yeah. So if you have 10,000 processors trying to share data and solve a complex problem together, the speed at which they communicate with one another becomes the main bottleneck.
Oh, I see.
It really does not matter how fast your individual processors are if the data pipeline connecting them is slow.
That makes total sense.
So Broadcom is benefiting specifically from demand for custom chips and the highly advanced networking infrastructure required to link all these processors together efficiently.
While Advanced Micro Devices is doing something a bit different, right?
Right. Meanwhile, Advanced Micro Devices continues to develop its own direct hardware accelerators. They are competing directly for a share of the core data center processor market.
Okay.
If overall spending continues, but customers insist on having more supplier options to maintain pricing leverage, Broadcom and AMD are positioned to capture that diverted capital.
Got it. But here is where we look at the other side of the ledger.
The losers.
Yeah, the losers in this scenario are the companies facing extreme valuation pressure. The main headline company here is Nvidia, ticker NVDA, alongside Advanced Micro Devices, ticker AMD.
Right.
The overarching theme is the risk of high expectations. When investors begin questioning future growth, or if there is any slowdown in infrastructure spending, it triggers immediate selling pressure.
Absolutely. Even strong companies experience short-term volatility during sector-wide market rotation.
Wait a minute. AMD is on both the winners and the losers list.
It is.
I need some clarity here. How can a company simultaneously win market share as a preferred alternative yet lose due to sector-wide valuation pullbacks.
Yeah, that contradiction highlights the very real difference between a company's operational success and broader market sentiment.
Okay, break that down for me.
Operationally, a company can be executing flawlessly. They can be winning new contracts, gaining market share from competitors, and increasing their total revenue.
Doing everything right, basically.
Everything right. In the real world, their business is thriving because customers desperately want an alternative supplier. That is the winner aspect of their current situation.
But the stock market does not just measure what a company did yesterday. It measures what people expect it to do tomorrow.
Exactly. That brings us to the loser categorization regarding valuation. You see, semiconductor stocks frequently move together as a unified group,
Like a pack.
like a pack. When large institutional investors decide they want to reduce their overall exposure to the hardware theme, perhaps because they are worried about the return on investment we discussed earlier, they will sell off the entire sector.
Just dump all of it.
Right. They reduce their holdings in all chip companies, regardless of individual operational successes. We also have to explain how valuation multiples contract.
So basically, even if the company makes the exact same amount of money, investors are willing to pay less for the stock because they're spooked about the future.
That is it exactly. Let's break that down mathematically.
Please do.
If a company earns $1 per share, and the market is wildly optimistic about its future, investors might be willing to pay $50 for that stock.
Okay.
That is a 50 times valuation multiple. They are paying a massive premium for future growth.
Right, betting on the future.
But if expectations cool off and investors demand a reality check, they might decide they're only willing to pay $30 for that exact same $1 of earnings.
Wow. Even though the earnings did not drop at all.
Exactly. The company's actual business has not deteriorated at all. They still earn that $1. But the stock price drops from $50 to $30 simply because the enthusiasm evaporated.
That is a harsh reality.
It is. When expectations are set incredibly high across the entire sector, the stock prices reflect an assumption of absolute perfection.
And nothing is perfect.
Right. If the broader market senses even a slight slowdown in capital expenditure from the major tech companies, those valuation multiples contract rapidly. So a company can be securing its position as a vital alternative supplier in the real economy, while its stock price simultaneously falls because the broader sector is experiencing a valuation reset.
That explains the AMD paradox perfectly. Now, the pressures on semiconductor companies aren't just about Wall Street valuations.
Right, not at all.
They are also heavily dictated by physical manufacturing borders and global trade dynamics.
Right.
Which brings us to our next group of market losers. We are looking at the semiconductor equipment companies, specifically Applied Materials, ticker AMAT, and Lam Research, ticker LRCX.
These are the companies that manufacture the highly complex, multi-million-dollar machinery required to actually fabricate the semiconductors.
The machines that make the machines, basically.
Exactly. And they are heavily exposed to global investment cycles. The specific threat outlined in the headlines is that China is rapidly expanding its domestic chip manufacturing capabilities. When you combine this rapid domestic expansion with ongoing export restrictions implemented by the United States, these leading equipment manufacturers face very real risks.
Right, because they're caught in the middle.
Yes. Investors are watching to see if China's progress in developing its own semiconductor technology ecosystem will result in permanently lower demand for the equipment supplied by American manufacturers.
It sounds like a dual threat.
It is a dual threat. You have lower China-related sales due to regulations and heightened global competition as foreign markets build their own alternatives.
So think of these companies like businesses selling the ultimate high-tech shovels during a gold rush, businesses booming, but suddenly the government tells them they are not allowed to sell those shovels to the biggest, fastest-growing mining camp in the world.
That is a very accurate way to put it.
But let me ask you this. If China successfully builds its own self-reliant semiconductor equipment ecosystem, does that permanently cap the revenue ceiling for companies like AMAT and LRCX, or does it just force them to innovate exclusively for Western markets?
It actually creates a permanent structural change in their total addressable market.
Meaning what exactly?
Total addressable market, or TAM, is simply the total revenue opportunity available for a product or service if it achieved 100% market share.
Okay.
Historically, these equipment manufacturers could factor the entire globe into their revenue projections. Their TAM was the entire world.
Right.
But if an entire geographical region becomes completely self-reliant and stops purchasing from outside its borders, that specific revenue stream disappears from the equation. The global pie shrinks.
So the ceiling just lowers.
Yes. While they will certainly continue to innovate and supply Western markets, the overall ceiling for their global sales is inevitably lowered if they are shut out of a major manufacturing hub.
That makes a lot of sense.
They are forced to rely on capacity expansion within the markets they are still permitted to serve, which makes their remaining revenue more concentrated and potentially much more volatile.
Wow, okay. So changing gears a bit, all of this hardware manufacturing, the data centers, the cooling systems, they all require massive amounts of power to operate.
Huge amounts of power.
Right. But when we look at the traditional energy sector, specifically giants like ExxonMobil, ticker XOM, and Occidental Petroleum, ticker OXY, they're currently sitting in the loser column.
Yes, they are.
But this is happening for entirely macroeconomic reasons that are completely divorced from the technology sector, isn't it?
It is. The dynamic in the energy sector right now is entirely driven by the underlying commodity. Declining crude oil prices are directly impacting profitability for these exploration and production companies.
This is a pretty straightforward equation, right?
Very direct. When the price of the commodity they pull out of the ground falls, their profit margins compress. What we are seeing right now is a situation where easing geopolitical concerns are removing the risk premium that previously kept energy prices elevated.
Let's ground that term for a second. A risk premium is essentially an invisible insurance policy that gets built into the daily price of a barrel of oil, right?
That is exactly what it is. When geopolitical tensions are high, for example, if there is a conflict in a major oil-producing region, traders add a premium to the price of oil.
They are pricing in the fear.
Yes, mathematically factoring in the probability that supply lines might be severed, shipping routes might be blocked, or production facilities might be taken offline.
So they pay more today, just in case.
Right. They are paying a higher price today out of fear that there might not be enough oil available tomorrow.
But when things calm down,
When those specific geopolitical tensions ease, that fear dissipates and the premium simply evaporates.
oof.
Exactly. The price of crude oil drops back down to reflect current normal supply and demand without the added anxiety.
And that hits the energy companies hard.
It does. For companies like ExxonMobil and Occidental Petroleum, that drop in the underlying commodity price directly translates to reduced earnings expectations.
Got it.
Wall Street analysts lower their profit forecasts, which in turn leads to lower investor interest and downward pressure on their stock prices.
So bringing this conversation back to the macro perspective for you as you watch your own portfolios and follow these markets,
Yeah.
the key takeaway from all of these headlines, whether we are talking about cloud infrastructure, custom processors, global trade restrictions, or commodity pricing, is that the market is strictly prioritizing profitability and actual revenue growth.
Absolutely.
Companies proving their tools and prove earnings will likely attract capital, while those relying entirely on future expectations face immediate volatility. You need to watch closely whether the current weakness in the technology sector is merely a temporary correction, or if we are witnessing a broader, sustained rotation away from high-growth tech names entirely.
Yeah, the market is demanding proof of concept. The initial phase of any technological build-out is funded by enthusiasm and heavy capital expenditure.
The hype phase.
Right, the hype phase. But the secondary phase, which we are entering now, is funded by actual business utility.
If they can't prove it works, they are in trouble.
Precisely. If the software companies cannot demonstrate that their enterprise customers are achieving tangible productivity gains, the entire supply chain from the software provider down to the networking companies and the equipment manufacturers will feel the financial impact.
Well, I will leave you with a final thought to ponder as you watch these corporate earnings reports roll in over the coming months. As enterprise software completely automates basic business operations to justify these massive infrastructure investments, will the next list of market losers simply be the non-tech companies that failed to adapt their workforce fast enough?
That is a great question to watch.
As a reminder, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.